The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
All right, welcome to the Happy Friday edition of the Daily Dots. It is Friday, July 18th. I'm going to go through the market, talk about a little bit of data, a little bit of news items, and then what I'm going to be writing about this weekend. I don't think it'll be too long a one, as you can probably tell by now. Chase rolling solo with you. Not a lot to report market-wise, as the S&P was down 0.01. The Qs were down 0.1. Today was a big options expiration day, which does put us on, a little bit of an alert next week for a little more volatility than we've had recently, but we'll see. Small caps were down 0.7. Equal weight was flat. Mag 7 up 0.7. All world ex-US down 0.22. The dollar finished down 0.16. It was a good bit weaker than that at one point during the day. So let me look real quick. Let's see. Yeah, we still had a positive week for the second week in a row on the dollar, and it's the first time we've had two positive weeks since back in May. We'll see how that continues to shake out. I still think we can work our way to the upside. But notably, Waller's speech yesterday about how he was in favor of cutting in July seemed to have moved the bond market, which doesn't really make sense to me because he's only one of 12. But regardless, that's what happened. It appears anyway. Oil finished down over 2%. You're not $66 there. Gold up about 0.4. Silver up about 0.4. Platinum down 1%. Good day for copper, up 1.6, 1.7. As I mentioned, so we were down a little bit yesterday on yields, and we were down another 3 basis points on the 2-year and about 4 on the 10-year. And then volatility was down about 1.5%. Still kind of where we've been stuck really for a while now. You're at just above 19. We've been hovering around 19 now for really like 3 weeks solid, and right at some like kind of the 50-week moving average. So all of that continues to be right around there. As far as data goes, as I mentioned early in the week, we were going to have starts and permits for housing, which is important because theoretically at least should tell you a lot about where employment goes in that sector, which is cyclically very important. Single family starts kind of breaking the trend line that they had placed the last few years. Not a good print. Same for permits. Really similar to last month. You had single family kind of ugly, and then you had multifamily looking pretty decent, especially on the permit side. Not good, but like given where we're at with rates and everything, not bad. So if you kind of look at the total permits and starts, it's not horrific. But if you look at single family, it is kind of bad. And that is important to note because single family is a little more employment centric than multifamily. Essentially it's more productive on the multifamily side. You can get more done with less people, meaning the, head count per unit completed is just a lot higher for single family, which means single family rolls over. If they both roll over, single family is more of a threat to the employment side. So that continue to be on watch for that, as I have been for 2 years. So I've already cried wolf on this, but I do still think it's important regardless. That was really the only data that mattered today, in my opinion. One of the things I want to talk about, and this is kind of picking up where I left off, I want to say last week, maybe a week before, on a Solo Dots episode, talking about the bill that just passed and what it could do to healthcare in a way that is definitely a negative for the economy. And that one of the things I talked about in that last episode was the Obamacare subsidies getting pulled out, and that was going to make a lot of people's monthly payment go up significantly, very significantly. But on the flip side, or in addition to that, what we're also going to see, and we're already seeing, is people people's just normal payments going up. So forget the subsidy, just, making it just naturally move higher, but just the bottom line, premiums are going to go higher. 17 states have already done their rate requests. We know that they're public. You can look at the data. You're up double digits. The median is up 15% year over year. And there's six different states that are up over 20%. So what you're going to have is, this is about 24 million people that use the ACA exchange for their healthcare. So it's kind of fair to say at this point, you're probably going to see people's rates go up kind of 10% to 25%, somewhere in there. Some states will be a little lower, some states will be a little higher, of course, but call it 15% just as a placeholder, because the median we're running at so far. And then a lot of people are going to have 15% higher premium, and then they're also going to lose a subsidy that maybe saved them, 10 to 50% or whatever. So a lot of people are going to have their health insurance go up by hundreds and hundreds of dollars per month, which, is going to squeeze a lot of people. And you can definitely make the argument this may end up not mattering that much, because as we talked about before, if asset prices are good and rich people are spending, as unfortunate as it is to be a reality, that can hold the economy up, even as the bottom, 50%, 75%, how you're going to look at it, even if they're really struggling, as long as the top is doing well enough, it makes up for everyone on the bottom, just because they spend so much money. It's just such a disproportionate allocation of consumption. But with that said, what you would expect, healthcare is and I covered this last time, but for anyone that didn't catch that one, healthcare is a really, really big employer. And for the last couple of years, it's been a significant driver of employment gains. So if a lot of people lose health insurance, which we know that's going to happen between Medicaid and just between it costing more. If you think about a lot of people, they're going to get the little thing in the mail that says, "Oh, by the way, your health insurance is $500 more than it was last year," and they're going to be like, "Yeah, no, that's not happening. Can't do it." And then people that don't have insurance, they go to the hospital, the clinic, the doctor a lot less, which means hospitals are going to get less visits, which means less revenue. They have very thin margins. They're going to have to let people go. So what you could see, and I would say this is probably more of a mid 2026 story, not anytime soon, but mid 2026, say that's kind of the trend. And at the moment, it looks like it, probably will be. My expectation would be you start to see healthcare jobs roll over. And if you go back to what I said about single family permits and starts for building homes, mid 2026, if rates aren't a lot lower on the long end, I would imagine you could see employment problems there. So you may end up in a weird situation where at some point in 2026, you have two of the main drivers of job growth both having problems. And then we know states right now are feeling a pretty big pinch fiscally. They kind of had that COVID largesse from the federal government that's kind of gone now. The tax base went flying higher and then settled out as real estate prices are actually running negative here lately. And that's obviously a big source of income for a lot of state and local governments. So their revenues are going to get kind of hit while their expenses keep naturally moving higher. Just like the federal government has that baked in the cake, Social Security, Medicaid, bump. I mean, if you think about it, so do states. States have the same thing for Medicaid, Medicare, the matching funds and all that stuff. And there's more of that to come in the future from the bill, where they have to kind of help pay for things like Medicaid and SNAP in the future. So you could actually see maybe some job losses at the state level, the local level. So it's not hard to paint a picture of some point in 2026, some pretty significant headwinds. On the flip side, it's not hard to figure out some tailwinds with what's going on in AI. The fact that, fiscally pretty stimulative at the federal level. There's plenty of things that look good. And more to that point, and pivoting to a completely different topic, is the way I'm kind of seeing the next, call it 2 months, is almost like a fork in a road, where you have like a really bullish and a really bearish, path you can take. Obviously, the bearish one tied to policy. If we see it through with really high tariff levels on most of the world, and we don't pull back on that, and it's serious and it sticks, through August, call it, then I think markets have a problem. And then if markets have a problem, the economy has a problem. I think it will drive some inflation. All that's bad for markets.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
On the flip side, something that's kind of a new emerging trend, not getting enough attention yet. Well, it's probably not going to get enough attention because, most people don't really follow liquidity on a deep level, but is liquidity coming out of China right now. That it's not like a really high number, but the growth rate in it has really accelerated and picked up. And that's important because, Chinese money supply, twice the size of America's money supply. So when they start juicing it, it's juicing a really big base. And you would see spillovers from that, obviously, into Chinese assets, but also into commodities, which we've been seeing lately. And if you think about what's going on in U.S. markets, you have a lot of, pull up a chart of ARK. It's ripping. You look at some like really speculative stuff that crashed after 2022. A lot of that stuff's picking back up, like Lucid Motors, things like that. All that stuff suggests like, man, there's a lot of liquidity out there. And I think the source of most of that global liquidity is coming out of China right now. Now, none of us know if they keep their foot on that gas or they take it off. Maybe they put it on the brake. Not sure. Usually under Xi, they don't like to keep their foot on the gas too long. So I think, this doesn't mean go out and buy everything, because they may well take the foot off the gas, maybe even put it on the brake. But if they keep their foot on that gas, that's a tide that will lift all boats. The way I kind of look at it, probably especially Chinese boats, and kind of saw like the last 2 days. If you look at like KWeb, FXI, just single names like Alibaba, like even with the dollar having picked up here lately, and which has hurt a lot of country ETFs, ex-US stocks have struggled a lot versus the US lately. But then you see China like kind of picking back up all of a sudden. And I think, my assumption is a lot of that is just that excess liquidity that's all of a sudden kind of flowing through. And that liquidity doesn't really hit economic data for, a few weeks, few months. It's kind of like a big time leading thing. I think you're starting to see it in some asset prices. You haven't really seen it yet in the data. Like housing data is still bad in China. They're still basically stuck in deflation. Like animal spirits are still bad. Like consumption's still too low. But that's actually all those things I just said are essentially why I think you do have the possibility they keep their foot on the gas on this liquidity thing. Is if you take it off now, like, will you have fixed your deflation problem? No. Will you have, gotten some animal spirits going for people to spend money and, beef up the internal economy? No. So I think they have to at least keep their foot on the gas a little bit longer. And if they do, commodities keep picking up, obviously Chinese assets, but also, speculative assets globally. You see it lately with, obviously for real reasons too, but like rare earth metal companies just, being up 100% in a week, 2 weeks, whatever. Pretty common here lately. So just something to think about. Obviously the hard part is you have both of those paths staring you right in the face for the next couple months. And, none of us know what China's going to do with their policy, and none of us know what the US is going to do with trade policy. So this becomes a very tactical, watch it every day, figure out what the main players in this game are going to do and try to react, knowing these two big forces are, one's pushing, one's pulling. Who's going to win that match? It just comes down to like, who does what here. And if they both keep happening, I think it's very difficult. Yeah. Then you may have a nasty liquidity event on the downside, and then a even stronger surge back than we just had, talk about like an ultra V shape with all that liquidity that would be, kind of stuck coming out of China. But none of us know how it's going to go, but we'll be following it every day. Along the way, just some interesting stuff I wanted to kind of toss out to close out the week. We'll be back Monday with more. Never forget, you can download and subscribe at knowyourriskpodcast.com. Check us out on YouTube, everywhere on social media. minus LinkedIn. Maybe someday. All right. Have a great weekend, everybody. Cheers.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.